Well, good morning. Welcome. I'm University of Illinois Extension's Todd Gleason, your host for this FarmDoc Daily webinar. This one's titled Bringing Clarity to Tax Changes in Agriculture. Our panelists for the day include Brad Zwilling, Krista Swanson, and Bob Rhea. We thank them for being with us. We would like to also thank our sponsors today, Compeer Financial, Corteva Agrosciences, Farm Credit of Illinois, the Illinois Corn Growers Association, and Bob, you can go ahead and move the slide set forward. TIA, the Center for Farmland Research, and the Gardner Agricultural Policy Program, FS Growmark, the Illinois Soybean Association, and of course, the College of Agricultural, Consumer, and Environmental Sciences. Without their aid, of course, the programs would not go on as well as they do. We appreciate all that they offer to us. We'll come back to them a bit later in the program, but for now, let's get started. Bob Rhea is here. He heads up FBFM, the Illinois Farm Business Farm Management Program in the state. Good morning to you, Bob. Thank you for being with us. Interesting subject line. I like the idea that you could bring some clarity to tax policy. I bet most people don't think that's really possible, but I've seen you in action before, so I think you're going to give it a college try today.
Oh, that's probably the right answer. We'll give it the college try. I think clarity is something everyone is looking for today in where we're going and how we're going to get there and when things become effective. So we have our program today laid out in a couple of segments. The first segment we see on our screen called Tax Planning in 2021. And so the first few slides are things that we do know, things that we know that farmers should be considering as they think about the last 60 plus days of 2021 and things that might be helpful even as they are unsure about what things might be coming. And our second piece of our presentation is about those things that might be coming. And of course, none of those are finalized, finished, or in law yet, but there are certain proposals that are out there, and we'll describe what some of those proposals are and how those might affect going forward business strategies. So hopefully between the things that we know and the things that we speculate about, we will bring some clarity to planning for the next 60 days. We start with this slide of things that we do know. In 1978 was the year that I graduated from high school, and I wasn't paying attention, Todd, to tax rates in 1978 very much. But looking back, the highest marginal rate in that time period was all the way up to 70%. And I believe there were 27 tax brackets that made us get to that 70% level. And we move then to what we have in 2021. We're at a 37% top marginal tax rate and only 7 tax brackets today. Now, here's the other interesting thing about today's tax rates. If I'm in a trade or business, this thing called QBIT, a qualified business income deduction, effectively shields 20% of my income from being subject to tax. Or another way to look at that, it reduces my marginal highest rate from 37 to only 29.6%, 80% effective of the 37% typical rate. And we think QBIT is here for a little bit, but there are changes proposed that might reduce that. And for most of our taxpayers in Illinois, they will have a 19.2% highest effective marginal rate. That takes them up to about $350,000 of income. That's a 24% regular rate, but using QBIT for trade or business income drops it down to 19.2%. So as we think about a 19.2 rate versus my graduating senior year of 70, a pretty significant reduction in rates over my career. And what did that mean for the average FBFM farm? In 1984, they paid $3,800 of income tax. In 2020, about $24,000 of income tax. So even though the rates dropped significantly, we do have higher tax liabilities on our farms today that need to be planned and managed accordingly. One of the ways we manage that is through depreciation deductions. And Brad will tell us a bit about some new things for depreciation. Brad, good morning.
Good morning, Bob. Yes, depreciation provisions, at least it's one thing that we do know. There's been years in the past that we didn't know what the answer was going to be, but this one we do know. The first thing is we have what's called 100% bonus depreciation through 2022. And basically that allows a farmer to take 100% of that asset as a deduction on their tax return. And it qualifies for all farm assets, including like a machine shed, a bigger building asset, and whether they're new or used. But the caveat to that is that you have to take all assets in a class. So if you do it on one piece of equipment, like a tractor, you have to do it on all pieces of equipment. So have to be careful and a little cautious with that tool, but it's available. And like I said, it's a good tool for those longer term assets such as a machine shed. And the other tool that we have is what's called a Section 179 or expense election deduction. And what that is that we can write off up to $1,050,000 of those purchases in a given year based on some other qualifications as a tax deduction. However, as we are buying those assets, if we have over 2,620,000 of those, we start phasing that out. And so once we phase, and that's dollar for dollar. So once we got over 2.6 million, we start phasing that out. So we get less and less expense election, and finally goes 100% away once you're at 3.6 million purchases. So it's an interesting tool. The one thing with that is it's for most farm assets. It's not for those longer term assets such as machine sheds, but new or used qualify. One advantage that the 179 deduction has over the bonus depreciation is you can pick any amount that you'd want to use, and it's by asset or by each individual assets that you have purchased. So it makes it a little bit more of a attractive tool to use. But in both cases with bonus or 179 deduction, if it's bought from a related party, they don't qualify for either of these. So if I purchase something from my father, I am not able to utilize either one of those assets. It has to be purchased from a non-related party. Also, with just the lack of used and new equipment out there as far as before the end of the year for buying equipment, it must be placed in service, which is the definition of in a state of readiness for its intended use. So if you need to purchase a new piece of equipment before the year end, if it's not in a placed in service in a state of readiness, you are not able to take that deduction for that. So an instance would be is I need to purchase a brand new combine, but that combine will not be bought until February of 2022. So that means I'm not able to, even if I pay for it 100% before the end of the year, I'm not able to utilize that asset. Bob, can you take the next slide?
Yeah, Brad, I would just add piece. I think you're describing a combine that might not be built yet this year. And so that was one that might have a challenge. And then we have some Illinois changes that are coming along that are not as favorable, Brad.
Yeah, so we talked about before the 100% bonus depreciation. Well, there's a little change in Illinois. Illinois has allowed that 100% bonus depreciation up until this year. So for tax years ending on or after 12/31/2021, no bonus expense or no bonus depreciation is allowed for Illinois. So what does that mean? That means for federal, you get to use 100% deduction on the federal tax return. However, on Illinois, it has no impact on that tax. You'll get to depreciate that asset, but it's over just the regular depreciation as if you wouldn't have taken bonus depreciation on that. So we lower the federal tax, but Illinois tax has a minimal impact on that. So there will probably end up having to be two depreciation schedules, one for federal and one for Illinois. The impact is in later years when you sell a piece of equipment or you trade it in, which is still selling it because that's how we handle that on tax returns. You potentially could have a different taxable amount for federal and Illinois. If there's still basis in that asset because of the bonus depreciation wasn't allowed for Illinois, there would be potentially a lot larger deduction on the Illinois side when you sell it. So lower Illinois tax, but higher federal tax. The federal tax would be the same one or the other. So Bob, with those pieces, what other year-end strategies can we go with those?
Well, one of the considerations, if we think about rates potentially increasing, we'll hear more about that in a moment, and we think their 21 rates are a good buy, this could be a year where pushing taxable income to a higher level and having it taxed at not more than 19.2%, and in some cases, maybe only 10 or 17%, might make some sense. So spend time with your tax professional and determine if a net result of a higher taxable income, 2021 could be a year where that makes sense, as we'll see with a few more pieces being discussed in a moment. If we're finding other ways to stretch out income, if we are in a phase of reducing inventory or selling machinery, there are chances to increase retirement plan contributions. We've added the solo 401k and some cash balance plans. Visit with an investment professional as well as your tax professional to determine how much could be contributed to these type of plans, and have, for example, a grain sale in 2021 contributed into a 401k plan that is then distributed out of that plan 4 years from now. Essentially, you've spread out that income over multiple years. Some flexibility can be created if you establish deferred payment contracts now and say, I'm delivering my grain and my price is going to be X. And one condition of my sale to the elevator is they're not going to pay me until January the 4th of 2022. And that pushes that income into 2022. But you have one option to elect out of that provision and move income back from 22 into 21, depending on what might happen in late 2021 year tax legislation. And Brad, I think the last bullet point, we'll expect much higher costs here. Do you agree?
Yeah, I agree. I think we're going to have some high costs. So having that flexibility with those deferred payment contracts will be very beneficial.
Some other pieces that are new and different in 21 that we just wanted to highlight as things that are not taxable: the economic impact payments that people are receiving for 2020 and 2021. These were the stimulus payments sent to taxpayers early on this year. So many dollars per person or per child. Those are not taxable income items, so be sure in your books and records they are shown as not farm income. The advanced child tax credit that certain people are receiving if they have children, those amounts, if they've elected to retain and receive those payments in advance, also non-taxable payments, but they will reduce the child credit that's taken on the 2021 return when it's filed next spring. But still a non-taxable amount. Don't get those on your Schedule F. And Brad, talk a bit about PPP forgiveness. We're not going to count that either, correct?
Right. We most of the PPP loans that were taken out early of 2021 or even in 22 were forgiven. And the tax law changes of a year ago, any of those expenses related to those now are no longer have to be counted back as income. So those are not taxable to your federal or state tax returns.
Right. We would include them as maybe earnings for the farm, but not as a taxable earnings. We have some things that are taxable. Also, the employee retention credit. If you have employees and meet the gross receipts reduction requirements and are going to get a reduction in your payroll tax, this employee retention credit is taxable, and it's taxable in a manner where it reduces your otherwise deductible wage expenses. If you had paid sick and family leave credits for employees, those are going to show up on your Schedule F as income on your tax return in 2021. And finally, we get questions about various FSA program payments. Brad, we're going to have to report those on Schedule F all the time.
Yep, and there's lots of those out there, so be cautious and make sure you know what those all are.
And you'll get a 1099 that will show up for some of those, or for all those FSA payments that will arrive in January to use as third-party verification. We're going to flip it over to Krista here, and Krista is going to discuss a little bit about policy and legislation that is really being talked about in the Congress even today, tomorrow, probably for a few weeks yet, Krista, but fill us in a bit about some of these bills that are making their way through the Congress and the discussion process, please.
Yeah, so as Bob just mentioned, there's a lot happening this week as we speak going on this. As I was working on putting together some of these slides, I was thinking about we need to keep them simple enough so that way we could adapt if there was changes that happened throughout the week. So the big topic right now on the policy front is this $3.5 trillion tax and spending package, which is now being referred to as the Build Back Better Act. And so the reason I have highlighted on here in red tax and spending is we are going to be focusing on the tax side, but importantly, this is a really large, all-encompassing bill that also includes a lot on the spending side, with policies related to education, healthcare, childcare, confronting climate change, and also includes, spending for agriculture. So I just wanted to note that, so that be sure everyone's aware that we kind of have both ends. And we, like I said, we're going to be focusing on proposals on the tax side. So Congress is trying to pass this bill through the budget reconciliation process. And the reason for approaching it that way is because going through that process would only require 50 votes, which means that Democrats could pass without any votes from Republicans. But there are a couple more moderate Democrats who are not supporting this as $3.5 trillion package. So over the past few weeks, party leaders have been working to scale back this package to a smaller value that could get the votes of those couple that are not supporting the larger package. So that's why it says here more likely will end up in the 1.5 to 2.5 trillion range. And actually just this week, President Biden laid out details for a significantly scaled back package that would be about $1.9 trillion. So it looks like that's more likely where this will end up. That's also a signal from the White House that it's time to get something into action, and that they're hearing what the few who weren't supporting the larger package were saying. So before we get into the details of the drafts for that Build Back Better package, I just wanted to mention something from some proposed legislation from earlier this year. So last spring, a different set of draft legislation called the American Families Plan included proposals for expanded spending and taxes, and a lot of that is kind of the framework for what is included in the Build Back Better plan. But I wanted to note a few pieces that were concerning for farmers that aren't in this Build Back Better plan that is making its way through Congress. So the first concerning thing in the original proposal was this elimination of automatic step-up in basis. And I'm going to say that again because it's really important. This wasn't eliminating step-up in basis. It was proposing the elimination of an automatic step-up in basis. There was a new transfer tax that would have applied to transfers in property. So essentially, you would be paying a tax to get a step up in basis as opposed to getting that step up automatically. And in this webinar, we aren't going to get into the details of what that would have meant for farmers, but there was a FarmDoc Daily article on May 28th that did go into detail on that. So another concern from the original set of proposed changes from last spring was limitations on 1031 like-kind exchanges. And that was also a concerning thing to farmers who sometimes use that to make trades of farmland to get a farm that may be closer to their home farmstead or where their land base is. And so again, these two proposed changes included in some proposals from last spring were concerning to farmers. And so on the positive side, they are not included currently in the drafts for the Build Back Better Act.
So Krista, you've already described the two major pieces here, the Build Back Better that's in progress and discussion, the American Families Plan, and of course the House Ways and Means is where the tax writing really happens, and they have other committee details you'll share with us too.
Yes, exactly. So the House Ways and Means Committee released some details in September that highlights their plans for the spending side of the bill and the tax side. And again, this does not include that transfer tax that was such a big concern or anything to change the 1031 like-kind exchanges. But it does make changes to the tax code, or I should say it does include proposed changes to the tax code that would impact farmers. And so we are going to be discussing 5 of the proposals in this set of, the proposed legislation that are likely to impact farmers. And as we've already noted earlier, but just to be clear again, this is not the final bill, so anything could change. This proposal that we're going to talk about is going to be subject to markup, and also with this scaling back from the total size, we know there's going to be some changes to get to a different package size. And so we don't know yet how or if that will change the tax side, which is our focus today. But again, we're kind of giving you our best interpretation of what's in this, given what we have to evaluate from today.
And generally, Krista, these are all going to be focused on higher income targeted levels, like the 400,000 or higher is where many of these increased rates apply. And the first one you're going to describe for us is back to the tax rates that I began our slides with, a slight change in these, again, for the higher income groups.
Yeah, exactly. And actually, that was kind of a big factor. We heard the Biden administration say often over the last several months that the goal was not to impact families making under $400,000. So that is a really good point to make. So again, talking through some of these proposed changes, and first up, a change in the top tax bracket rate. So this would increase the top tax rate. Bob mentioned earlier, that's 37% currently. So it would raise that to 39.6%. And Bob talked earlier about how these levels are low compared to, he used the example from the 1970s. I would also note that this 39.6 rate goes back to what it was before the 2017 Tax Cuts and Jobs Act. So it was 39.6%. That act in 2017 brought it down to 37%, and this would revise that back to what it was. So, and then also there's a lower starting point for the top tax bracket to begin at than where it would currently. And so this could impact some farm families depending on their, total taxable income. So wanted to point that out.
Krista, we've seen a big increase in land values the past 6 months, and land is one type of long-term capital gain asset that farm families have, but so are breeding stock. But there's some proposals about raising the tax on some of these asset sales too.
Yep, exactly right. So talking about what would happen with long-term capital gains rate, this proposal would increase the highest long-term capital gains rate from 20% to 25%. This is higher than prior to the 2017 Tax Cut and Jobs Act because that didn't make any changes to the rate on long-term capital gains. One thing I wanted to note is that American Families Plan proposal from earlier this year would have taxed long-term capital gains at the same rate as ordinary income. So when we look at this with that in mind, yes, this is increasing, but from the positive point of view, that 25% rate, if passed with this provision, is likely lower than what it would have been if taxed as ordinary income following the ordinary income tax rates. Of course, depending on, like Bob just mentioned, there would be a big difference in the value of maybe capital gains on a land sale versus breeding stock. But in general, having that tax as ordinary income could have resulted in higher tax rates. Bob, do you have anything else on that for Brad?
That could be, the ordinary rate could be as high as the 37% currently, or proposed 39.6. Yep. So there is still some pressure to increase rates on capital gains. And we have a proposed effective date, but still waiting to see of when that really comes into play and if there's going to be any look back at all. But just an awareness that there is pressure on capital gain rates. And then many of our farms are organized as corporations. And here we're talking about those who are organized as C corporations, Krista, not S corps, but C corps who pay their own tax. A change in how these tax rates apply to those family businesses too.
Yep. So this proposal would transition from a 21% flat tax rate, which was a result of that 2017 Tax Cuts and Jobs Act. It transitioned corporate taxes for those C corps from a tiered scale, which ranged from 15 to 39%, depending on income, to this 21% flat scale we have now. So although this House proposal that we're working from here as we talk is moving back to a tiered scale, it's generally more favorable than prior to those to where we were prior to when 2017 made changes. So the first 400,000 of income would be taxed at 18% under this proposal. 21% would be applied to incomes up to 5 million, and then a rate of 26.5% above that level. And so with this graduated scale, corporations with income of up to about 5.2 million would actually pay a lower tax than with the 21% flat rate. So this is oh, go ahead, Bob.
Well, in the old days, it was 50,000 tax at 50%, and you got to the highest 34% rate at 100,000. So these graduated rates are below the old news too, and would be helpful to many farm family corporations, I think.
Yeah, exactly. So now we're moving into estate taxes. So as I noted earlier, this proposal does not include the transfer tax as was written into some of those proposals we saw earlier this year. But it does propose lowering the exemption level for estate taxes. And so when I say exemption level, I'm talking about the amount that is exempt from being subject to estate taxes. This House proposal would lower that existing estate tax exemption level from an inflation adjusted 10 million per individual, which is at 11.7 million for 2021, to an inflation adjusted 5 million per individual. So it's cutting that exemption level in half. And again, that's the level essentially where above that is where you start paying estate taxes. And I just wanted to note, since I've kind of mentioned with each of these how this compares to prior to that 2017 Tax Cuts and Jobs Act, this actually is reverting us back to where we were before that. So that act doubled this exemption level, and then this proposal would be taking us back to where it was before that. Another thing to note is that in 2020, only 0.16% of U.S. farm operator estates owed estate taxes, owed federal estate taxes with this higher exemption level. So if this exemption level is cut in half, more farm estates are going to owe estate taxes. So I also want to note that Illinois does have state level estate taxes. Everything that I'm talking about is at the federal level. Bob's going to talk more about that.
The Illinois estate tax is based above that 4 million exemption level, and it's calculated at this unique method at the Illinois Attorney General Estate Tax Calculator website. It's a mouthful, but that's the only way we get these numbers. And so I put up a couple here of 3 different types of operations. They both have, or all 3 have $8 million at the end of the day of an estate. So essentially half tax-free, half taxable. But notice the left portion of the slide where the taxable amount varies in these 3 scenarios. So in scenario 1, the farm family gave nothing away during lifetime. In the second scenario, they gave away $3 million. And in the last scenario, they gave away $6 million. So they have a taxable estate of only 2, but Illinois makes us add those gifts back. But it does change the Illinois estate tax considerably. So if we think about an $8 million individual estate, $680,000 of Illinois tax would be due, and zero federal under today's current rules, and even under the proposed rules, might not be too big of a number depending on that exemption. And so some are thinking, well, let me give some money away today and lower the tax. Well, it helps. It doesn't wipe it out. So this is just designed to give us some exposure to how the Illinois tax is calculated and the effect of major gifts during a person's lifetime to lower that tax. One other factor that affects the farm estates, Krista, is Section 2032A, this special use valuation. Some big changes in store here proposed.
Yeah, and what's interesting about this special use valuation, it may be something that a lot of farmers aren't real familiar with because it's not something that's currently widely used. And we'll talk a little bit about why that is, why it's not necessary much today, but with this combination of proposals, why it could be. So what this is it's the special use valuation for certain real properties that are used in farming or other trades and businesses. And it's in section 2032A of the tax code. And it would allow descendants who own real property used in a farm to value it based on the actual use instead of the fair market value for determining estate taxes. So as an example of where this might be used, if there's farmland that's on the outskirts of an urban area, it may have demand as a developmental property at a much higher rate than what its use value is as farmland. So this provision was originally established in 1997 and has not been updated since then. The House proposal would update the allowable reduction in base from an inflation-adjusted $750,000, which is currently at $1.19 million, and it would increase that to $11.7 million. So a huge increase. And we'll talk a little bit more about what that means in a few moments. But when qualified, that farm use value could be used in determining the taxable estate value. So there are some conditions and caveats to using this. The family must continue farming for 10 years. And although the provision would lower estate taxes owed at the time, the basis carried forward is also lower. It'd be at that use valuation level instead of that higher fair market value. And so, as I mentioned, it's not really currently widely used because first, the allowable reduction is so low compared to the value of farmland. And then also the estate tax exemption level is high enough relative to the value of farm estates. So we are going to talk through, like I said, we'll talk through an example here in a few minutes, but first Brad is going to explain how this valuation is determined.
Yeah, Krista, it's not intuitive of how this calculation is done. So let's walk through an example here of with our current rules, what that 2032A example would look like. So we're first trying to establish that use value. And how do you do that? Well, first you determine the fair rental value of the acre. So in this case, we'll say $300 an acre. And then you subtract out the real estate taxes paid because we can get to a net rental value of $270. So once we have that, that's our use, that's what we get per acre on a use of that ground. IRS has a 2032A rate that they come out every year with, and for 2021, and that's based off what farm credit system territory you're in. In Illinois and most of the Midwest, it's an AgriBank FCB territory. So that rate is 4.62%. So you take your net rental value and divide it by 4.62%. And the use value then is $5,844 for this calculation. If we say, just for instance, that farm ground is worth $12,000 an acre as fair market value, that would be a reduction. You take that 12 minus that use value of $6,156 is a reduction. If you divide that $6,156 in our current $1.19 million reduction, that would mean you could take 193 acres of that reduction on. Now, with the proposed rules, where we're actually taking that reduction, that 1.19 times almost 10 times, that means if the proposed, we could do this on almost 1,900 acres if they increase that deduction or that reduction to 11.7 million. So, Krista, you want to walk us through an example of why we've not been using it so much?
Yeah, for sure. So I'm going to set the stage for the scenario we are using first. So this is looking at an estate transition, and we're going to assume that we have 500 farmland acres owned and no other assets or debt. We are also going to assume a fair market value of $20,000 per acre. And on the last slide, Brad showed that example that resulted in a $5,844 use valuation. So here we're going to assume kind of a rounded up valuation to $6,000 per acre, which could occur with a slightly higher net rental value than Brad was using on the last slide. But we would get to that using that same process he just talked through. So the net estate value based on that fair market value is $10 million. So I'm getting that by taking 500 acres at that $20,000 per acre fair market value. So for right now, we're not using that use valuation, but I wanted to include that here. So first, let's look at what this means for federal estate taxes under the current law. So currently, that $10 million estate value is less than the $11.7 million estate tax exclusion level. So there's no federal estate tax owed because the total value is under the exclusion level. And so the resulting tax basis is $20,000 per acre, that fair market value at transition. Under the proposed law, that $10 million estate value is more than the $5 million exclusion level. So the first $5 million is excluded from estate taxes, and that leaves $5 million subject to estate tax. This would result in about $1.9 million of federal estate tax owed. Again, we're just focusing on federal for the purposes of this example, but as Bob covered, there's Illinois estate taxes as well. And so after paying this tax, the resulting tax basis is $20,000 per acre. Again, that fair market value. So the family, under proposed law, looking at those estate exclusion level changes, this is what it would mean in this example.
I think, Krista, we'd add that even under the current law, that Illinois estate tax would be real close to $1 million. So even though it looks good from the federal side, still some planning would be needed on the Illinois side.
Okay, yep, that's a really good point. Thank you. So now we're going to look at how Section 2032A, that special use valuation, comes into play. So under current law, the consideration to use Section 203A isn't even necessary because there wasn't any federal estate tax owed using that higher fair market value number. And again, we're talking about the federal, we're focused on the federal view, which, like Bob pointed out, if you're doing estate planning, you would need to consider, the big picture, including your state's estate tax, if applicable. So from the federal perspective, it doesn't even make sense to go through the calculations or to figure this Section 2032A special use valuation or be subject to the conditions and caveats of using it because at that higher fair market value, you're not subject to the federal estate tax. So you can see why this is not a widely used provision among farm estates. So under current law, under proposed law, the combination of the proposal to lower the estate tax exemption level and raise the Section 2032A allowable reduction could make this appealing for some farm estates. So going back to our scenario, that fair market value was $20,000 an acre, and our use valuation was $6,000 an acre. So the reduction is $14,000 per acre, or $7 million total across all 500 acres. That $7 million reduction would be less than the 11.7 maximum reduction under this proposed law. So the reduction would be allowable in full. So if this farm family elected to take the full reduction, the estate value would be $3 million. That would be calculated based on that $6,000 per acre use valuation times the 500 acres. And that $3 million estate value is less than the $5 million estate tax exemption level. So there would be no federal estate tax owed in this case. But there are caveats and consequences of that decision. So if you elected to do that in full and apply that full reduction, your resulting tax basis is only $6,000 per acre. So notably, had you not elected to use that special use valuation reduction, you would have paid that $1.9 million in a federal estate tax and had a $20,000 basis per acre. In this case, you decided to take the special use valuation, not pay federal estate tax, but you are only getting a $6,000 per acre basis as after that estate transition. Also, the land must be farmed by family for 10 years, and the IRS is a lien holder on the land in the amount of the estate tax deferred. And of course, that lower basis level means that it's more likely to have capital gains tax owed when this is eventually sold or passed to the next heir. So anyway, really want to just highlight that, like what I just said, that difference in that resulting basis level is important.
Krista, I think a key phrase you have on this slide is the one in quotes in the third bullet point, deferring the tax, both of the estate tax and then essentially maybe deferring income tax that might result in a larger capital gains later. There are also significant requirements in both pre-death for the family and post-death for the family to qualify under 2032A. We've not gone into the qualifying language and requirements today, but there are significant requirements that must be met to even get to this slide that makes you eligible. The other two comments I would have is even if you had less than had a $10 million estate that wasn't taxable today, you might use 2032A on your Illinois estate tax return because that only has a $4 million exemption. So I think we do see some Illinois 2032A calculations when it's not required on the federal. My final comment is these are very helpful, or this higher exemption is very helpful, but it's only on the land, as Krista has clearly described. We haven't done anything here to help shield the farm machinery or the farm inventory, the farm livestock from potential higher estate taxes in some of these proposals.
Thanks so much for those additions, Bob. And kind of just to reiterate, an interesting aspect of this, the combination of proposed changes. So, and when I say that, I mean this reduction in the estate tax exclusion level paired with an increase in the allowable reduction under Section 2032A. That combination of proposed changes kind of gives farm families the option in qualifying situations, like Bob just pointed out. There's qualifiers to be eligible, but in a qualifying situation, it's kind of giving that option to choose to pay for a step up in basis or defer that tax liability. So the thing that stands out to me is that it kind of seems similar to the transfer tax proposed last spring under a different approach, and just something to be aware of. And if this is passed and these proposals that we're talking about come to fruition, I'm sure we will be covering examples like this in greater detail in the future. So kind of to recap, so federal tax changes, some positives in the current proposed tax changes compared to some of those proposals we saw earlier in the year. Also, just keep in mind, as I think we've made very clear throughout this, we talked about with the information that we have today, our best interpretations, but this is not law yet. And of course, if the package price tag is lowered, as we see that happen here, some of these tax and proposals may be adjusted as well. And when it comes to special provisions, you can expect calculations, caveats, and consequences. So that's something to keep in mind. Sometimes something seems like a good idea or a tax saving plan, but it may come with some strings attached. And then also, again, this isn't final. At this point, I wouldn't assume anything is off the table in terms of changes to come. And I think that we're definitely seeing action happening in Congress on this week. And I think in the next week or two, maybe there'll be more clarity to what's happening.
I'm going to just give a final wrap up from my view, and then Brad, I'll ask you to chime in too. But I would just say this is certainly a time when flexibility is critical, advanced planning is critical, and connecting with your tax, investment, and legal professional is critical, because we know that there could be some changes coming, and those might not happen until the third Friday in December, which is the scheduled adjournment of the U.S. Senate. And that has sort of been a targeted date in the past few years when legislation has occurred, just not very long before Christmas. And of course, this year we had legislation as late as March 11th of 21 that impacted 2020 tax returns. So when Krista says nothing is off the table, absolutely right. We hope we know these things in advance. And Brad, any closing comments? And then we'll get to the questions we have.
Yeah, the only thing is, like Bob said, is get your team formed, but also have a discussion with your family. With some of these tools, such as the 2032A, it requires some of the family to be farming in the future. Maybe those heirs don't want to do that, so that option may be off the table. So make sure you're having discussions with your whole team, your trusted advisors, as well as your farm family.
Right, and we would hope you would include FBFM staff in that discussion. We've had these same discussions at our professional conferences over the summer, and everybody's tuned into that during our tax schools coming up as well. The questions that we have: if 2021 grain was marketed for deferred payment, could one still transfer some of that income back to 21? Yes, that's possible. These transfers back to 21 are done on a contract by contract basis. So if you have 5 different contracts marked as deferred payment, you could move 1, 2, 3, 4, or 5 of those contracts back to 2021. And you do that simply by reporting that income on your 2021 tax return. Krista, can you highlight the article again that you mentioned about the AFP?
Yes. So it was from, did I say, just a minute, let me.
It's
And
from May the 28th. And I put a link to that
Okay,
article,
yeah. So
by the
it
way.
was from May 28th, and it talked, it used FBFM data actually to look at how the number of farms, the percent of farms that would be impacted by the tax liability from the transfer tax as it was proposed in the American Families Plan.
And again,
Thank you, Krista.
I put a link into the question box so that people can find it easily enough. And if you go to the FarmDoc Daily website in the search bar and put in transfer tax, it'll pop up. You'll see it. So it's from May the 28th. Before we get to the rest of the questions, just a reminder that our program today was sponsored by TIA, the Center for Farmland Research. That's here on campus, farmland.illinois.edu. The Gardner Agricultural Policy Program, Compeer Financial, Farm Credit Illinois, Corteva Agri-Sciences, the Illinois Corn Growers Association, the Illinois Soybean Association, FS Growmark, and of course, the College of Agricultural, Consumer, and Environmental Sciences, and the Department of ACE. A couple of other things, and we do have a couple of more questions to get answered as well. And you can continue to submit those if you'd like. If you want to watch this again, you can find it or pass it along to anybody else on the FarmDoc Daily website. Just look for webinars in archives, or you can go directly to youtube.com/ Farm Doc video. Jim Baltz is behind the scenes today, and he'll work pretty feverishly during the day to get this back up on that website. Should probably be there later this afternoon. Jim's usually really good about taking care of that. There are 3 more, or actually 2 more, of these programs that you're already signed up for since you're here. Next Thursday, we'll talk about farmland markets. That'll be, I believe, with Bruce Sherrick and Gary Schnitkey. And then on the following Thursday, that'll be the first one in the month of November, we'll talk about machinery cost and management. And Dale Latz, and I think Gary Schnitkey will be in on that one. Gary and Dale have already authored an article about machinery costs. That's in part the way folks put together their custom farming rates as well. So you're signed up for those, but those will be coming up. I think maybe there are a couple of more questions yet to be answered. Is that right, Bob? If not, I've got a couple of questions on my list that
Well, I have one on our screen that Jim has put up, speculating on gift tax exclusion amounts and potential value discounts for undivided minority interest in FLPs or LLCs. In some of the earlier proposals, those were eliminated. And as we think about discounting, there's really 2 steps to that. It's a discount for minority ownership and a discount for marketability interest. And one of those, I forget which one, was targeted for elimination. Those are not in some of the House proposals that Krista has identified. Those have, just recently been supported by legislation and court rulings. So I think those discounts are always on the chopping block as one more way to impact higher estate value taxpayers, and one way to reduce the cost of proposals. So I would stay tuned. They are not in there currently, but it's certainly easy to bring those back. Todd, what are your questions?
Well, there was one submitted ahead of time. What should appraisers be aware of as far as tax changes that could affect the end of the year workload? Maybe you might all take that up very quickly. And I've got 2 more.
Krista, do you want to comment about Todd's? We were chatting about that before we came on.
Okay, so what should appraisers be aware of as far as tax changes that could affect the end of the year workload? I mean, I guess maybe I'm not taking it the correct direction, but one thought is, those capital gains taxes that we talked about, while it does seem like those are going to end up being higher, as written in the House Ways and Means Committee details, that would be effective back in September. So I don't know that for the anticipation of higher capital gains rates that there would really be any extra workload in terms of people making sales prior to year end, unless that effective date is changed. That change would already be effective once this is eventually passed. So that's something to keep in mind as well.
I would add to that that if the slide we had about the Illinois estate tax, if farm families decide to make larger gifts by year end, because either the exemption is being reduced or they want to do something about Illinois estate tax, that's a role appraisers have a key place. And so if there are large gifting ideas coming along, that could impact appraisers. And if there are 2032A calculations needed, that could also impact appraisers as we think about potential tax changes. Todd?
And finally, a Section 179 question and one on PPP that I'm not sure any of you will know about. On Section 179, you said you can spread that over more than one tax year, can that be spread over more than one tax year, or is it for only the year that was placed in service? So my question really has to do with, if you don't take it all, do you lose it?
Yes, you do lose it as far as whatever you take this year is what you get for this year. And so if you place it in service in 2021, if you don't take the full amount of it, then it has to depreciate over the useful life. So you don't completely lose it, but you don't get it all the following year. There's a nuances with not having taxable income or actually from a trade or business, but that's a whole nother webinar. So make sure you reach out to your tax provider on those pieces.
Right. So section 179, if you use all or part of it, but if you only use part of it, then you have to use the depreciation schedule for the rest of it. Is that
Correct.
correct? Right. And then on PPP, are there any clawback issues and on PPP at the state level? I think there's some talk in Illinois, maybe related. This would not be business related quite, but for not for profits. That's why I wasn't sure whether you would know about this issue.
Bob, do you have any information on that?
Are you describing a clawback where the non-for-profit might have to recognize that as unrelated business income, Todd? Is that what they're driving at in the question?
Yeah, that they'd have to, that part of it would be
Taxable?
I think matching funds probably would not come in or something like that.
Oh, if they were having donations arriving, but they had PPP funds that might inhibit their ability to obtain other donations. Oh, that's yeah. I've not heard about that, but that's certainly not in our tax or accounting world. That's more in, I guess, the philanthropic world of how those might impact potential donors. The PPP piece itself is treated as a loan on your books initially, and then debt forgiveness after that. And that debt forgiveness by statute has been deemed to be a non-taxable event. How that might impact donors, I'm not drawing a connection to that piece yet, but we are close to our 12 o'clock adjournment time. And Todd, I'll let you close us out. If you have other questions, we will.
On that note, I should close out, eh?
Close me out of one I don't know anything about. How about that, Todd? And maybe we should one more time thank our friend here in the room beside me, Jim, who has put together, touched up our slides, and many of the background slides you saw of farm harvest fields, Jim, I'm guessing came from your personal video camera. So we thank Jim for his work to help make all of these FarmDoc webinars look good and come off without hitches. Thank you, Jim.
Indeed, he does. Jim Baltz works really hard behind the scenes. Again, he does a lot of front end functions to make sure that things look good on your screen and during the program to make sure it's delivered properly, and after the fact to make sure it is archived. I do also want to make sure that when we stop or when you leave, you fill out that survey. Jim puts that together and tallies it for us. We'll see it this afternoon too. So be sure to put your comments in. Tell us what you think. And we do thank Brad Zwilling and Krista Swanson and Bob Rhea for being with us. I've been your host for the day. This is Bringing Clarity to Tax Changes in Agriculture, part of the FarmDoc Daily Fall Webinar Series. And we thank you for being with us. I'm Illinois Extension's Todd Gleason.